And today, we're tackling something absolutely fundamental. Money.
Right. We all use it. We think we know what it is. But the question we're digging into is, where does the vast majority of the money you earn, you spend, you save, where does it actually come from?
It sounds simple, maybe, but the answer most people give, cash from the government or deposits in a bank, well, that's only a tiny piece of the puzzle.
It's like the tip of the iceberg, isn't it?
Exactly. To really understand currency today, you have to look beneath the surface, behind the sort of the standard explanations.
Absolutely. So our mission today is a deep dive into some pretty comprehensive source material, and it makes a claim that honestly sounds disruptive, almost unbelievable at first.
It does. The claim is that in major developed economies, think the US dollar, the Japanese yen, something like 99% of the money supply isn't what you think it is.
It's what?
It's actually someone else's debt.
99% debt.
Yeah. That figure, 99%, it's not just a theory or a guess. It comes from looking hard at the empirical data. It reflects the mathematical reality of how the modern debt money system actually functions. The vast majority of money circulating is, simultaneously, a liability someone owes.
Just think about the scale of that for a second.
Yeah.
You look at Japan's M3 money stock, that's a broad measure of money. It's over 1,400 trillion yen.
Huge numbers.
And if 99.7% of that is debt money, it completely blows up the traditional textbook idea, doesn't it? The idea that banks are just, middlemen lending out cash people have already saved.
It absolutely does, because if you look at M0, the base money, the actual cash and reserves the central bank creates, it's just a tiny fraction of that M3 total.
So the question becomes, if banks aren't just lending out existing cash, where did all those other trillions of yen, or dollars in the US case, actually materialize from? How are they created?
And that's what we're getting into. We're diving into decades of detailed financial accounts from the US and Japan to see the exact mechanism, the verifiable process.
So this isn't just about abstract theory.
Not at all. This requires going beyond mainstream monetary ideas. The research we're looking at had to really focus on the operational and legal nuts and bolts of money creation to actually validate that 99% figure.
It sounds like forensic accounting almost.
It's a bit like that, yeah. Forensic accounting combined with legal history. And what it reveals is that the common understanding, the accepted wisdom about banking, it's, structurally inaccurate.
Okay, so if you're going to make this massive claim that money stock basically equals total debts, the first thing you absolutely need is solid, reliable data for the money stock itself. You need consistent measures.
That's right. And this turned out to be the first major hurdle, especially when the researchers looked at the data from the Bank of Japan, the BOJ.
What was the issue? Getting the data or the data itself?
The data itself.
Yeah.
When they initially tried using the standard official time series data for M1 and M3, these are common measures of money supply published by the BOJ, they immediately hit a wall.
A wall? How so?
Inconsistency. Major inconsistency. The long-term data wasn't one continuous series. It was actually chopped up into 3 separate periods that were officially discontinued. One from 1980 to 88, another 88 to 2008, and a third from 2003 to 2019.
Okay, different periods. But did they connect smoothly?
Not even close. That was the problem. At the points where these different data series were supposed to join up, the numbers jumped around wildly. There were huge, sudden changes that didn't reflect economic reality.
Like how big?
Well, get this. In 2008 alone, right at one of these transition points, the official M1 data suddenly spiked by 111 trillion yen.
Trillion, with a T.
Trillion. While M3, in the same year, plummeted by 186 trillion yen.
Wait a minute. You're saying the official money supply figures jumped up or down by amounts equal to, 1 or 2 times Japan's entire national budget, just because of a data series change?
Precisely. It creates an enormous statistical fog. How can anyone, businesses, investors, policymakers, make sensible decisions if the basic numbers tracking the money supply have these massive, unexplained jumps and breaks in them?
Yeah, that sounds completely unusable for any kind of long-term analysis.
Exactly. The researchers realized they couldn't build their argument on data that was fundamentally broken like that. You can't analyze trends if the timeline itself is fractured.
So the official headline numbers from the BOJ were out. They needed to go deeper, right, to build a consistent series themselves.
That's what they had to do. And that led them to the flow of funds accounts, the FFA. These are also published by the BOJ, but they are much, much more granular.
Flow of funds. What does that actually track?
Think of it as the detailed financial ledger for the entire economy. It tracks the flows of money and credit and the resulting stocks of assets and liabilities across dozens of different sectors, 45 macroeconomic sectors to be precise,
Wow.
and across 51 different types of financial transactions or instruments. It's incredibly detailed.
That sounds like an astronomical amount of data.
It is. We're talking about 40 years of quarterly data for Japan alone. That adds up to something like 734,400 individual data points.
Good grief. Processing that must have been a challenge in itself.
Oh, absolutely. The source material mentions they had to develop highly specialized analysis models just to import, manage, and calculate with this sheer volume. It wasn't like just downloading a spreadsheet.
It sounds less like reading a report and more like, I don't know, assembling a giant complex financial machine.
That's a good analogy. The key point is, to get reliable, continuous data, they had to sidestep the BOJ's summarized break-in statistics and go right back to the foundational accounts, the FFA.
But even using this incredibly detailed FFA data, there was still a little tweak needed for the Japanese numbers, wasn't there? A technical adjustment?
Yes, that's right, a small but important one. They found that when they calculated M1 and M3 using the standard definitions but applying them to the FFA data, the results didn't quite line up perfectly with the official, though broken, reports. There was a slight timing mismatch.
How so?
It seems their calculation model was pegging the stock values, the amount of money, at a point in time to the beginning of each period. But the official BOJ convention referenced the end of the period.
Ah, okay. A difference in accounting convention.
Exactly. So for the JPY analysis, they implemented a systematic one-year shift to their FFA-derived data, pushing it forward by a year, essentially.
And did that fix the alignment?
It did wonders for M1. After that one-year adjustment, the M1 series calculated from the FFA lined up beautifully and resolved those nasty discontinuities in the official series. It gave them a reliable, continuous M1 measure.
And M3.
The M3 fit wasn't quite as perfect after the adjustment, but their FFA-derived M3 series generally tracked nicely between the three different disconnected official M3 series. It provided a much more plausible and continuous baseline than the official data offered. So the FFA approach, with that adjustment, was validated as the way forward for Japan.
Okay, so Japan required some serious data archaeology. What about the U.S.? Was getting reliable data from the Federal Reserve easier?
Thankfully, yes. It seems the U.S. data was more robust and consistent over the long term. For the U.S. analysis, the researchers relied on the financial accounts of the United States, or FAUS, which is the Fed's equivalent of the FA.
And how do they verify its reliability?
They did a direct comparison. They took the standard M2 money stock data, readily available from FRED, that's the Fed's big economic database, and compared it line by line with an M2 figure. They calculated themselves directly from the detailed FAUS data.
And the result, how close were those two lines?
Very close. Remarkably close, actually, going all the way back to 1945 and right up through 2022.
No major breaks or jumps like in the Japan data?
No. Now, the M2 calculated from the FAUS was generally a little bit higher than the M2 number straight from FRED. There was a gap, and the widest difference reached about $1,068 billion back in 2007.
Which sounds big, but in the context of the total money supply.
In the context of a multi-trillion-dollar M2, and more importantly, the movement and the trend of the two lines, they tracked each other almost perfectly. The shapes were nearly identical.
So that confirmed the FAUS was solid ground.
Yes. It meant that the FAUS, like the adjusted FFA in Japan, was a reliable, continuous source for measuring the money stock. This methodological groundwork, establishing trustworthy M2 and M3 series, was absolutely essential. It was heavy lifting, but it built the foundation needed to confidently test that core hypothesis about money and debt.
Right, so with reliable measures of M finally established, we can now get to the main event.
Exactly. Now we get to the core empirical finding, the result of all that data work. And it's stark. Money stock is historically approximated by total debts.
Meaning M2 in the U.S. tracks total debts, and M3 in Japan tracks total debts.
Almost perfectly. When you plot them on a graph, especially the U.S. data going back to 1945, the line for M2 and the line for total debts are virtually indistinguishable. They move together step for step.
And they show that dramatic acceleration, right? Especially after 2000.
Exponential growth, yeah. Both lines curve upward sharply. It really stops being a theoretical argument at that point and becomes more of a description of reality. The data shows that the money supply, structurally, is the debt supply.
Okay, but we need to be really clear about what we mean by total debts here. It's not every single IOU in the entire economy, is it?
No, absolutely not. That's a critical distinction. We're talking very specifically about money-creating debts.
Money-creating debts,
Yep.
meaning
These are specific types of financial liabilities where the very act of taking on the debt results in the immediate creation of new money, usually in the form of bank deposits. This new money then appears as an asset on the banking sector's balance sheet.
Okay, so what types of debts actually do that? What falls into the specific total debts category?
There are two main components. The biggest one is usually the liabilities owed by what the accounts call the non-banking private sectors.
So regular people and regular companies.
Exactly. Households, corporations, non-financial businesses. When you or a company takes out a loan from bank, say a mortgage to buy a house or a loan for business expansion, that loan becomes an asset for the bank. And crucially, at the same exact moment, the bank credits the borrower's account with a deposit. That deposit is new money created alongside the debt.
Okay, so private sector bank loans are the first big piece. What's the second?
The second major component is government debts. Specifically, we're talking about treasury securities, government bonds, and bills.
But not all government debt. Which parts count?
Only the parts held by the banking system. That means treasury securities held by commercial banks, and very importantly, those held by the central bank itself, the Federal Reserve in the U.S. or the Bank of Japan.
Ah, so when the Fed buys government bonds, that creates money too.
Correct. That's a key mechanism. So total debts, as defined in this research, is the sum of these specific items: private sector loans from banks and government securities held by banks and the central bank, all viewed from the asset side of the banking system and central bank balance sheets in the SAFAUS statistics.
Okay, got it. So let's quantify this relationship for the US dollar using that long period from 1945 to 2022. Just how tight is the connection between M2 and this specific measure of total debts?
It's incredibly tight. Statistically, the strength of the relationship is, frankly, staggering. The correlation coefficient, R, between U.S. M2 and total debts is 0.9985.
Wow, that's almost what perfect correlation is one, right?
Exactly. It's about as close to a perfect positive correlation as you can realistically get with real-world economic data over such a long period.
And what about R squared? That tells us how much of the change in M2 is explained by the change in total debts.
R squared is 0.997. So 99.7% of the variation in the U.S. money supply M2 over nearly 80 years is statistically explained by the variation in these specific money-creating debts.
That's definitive.
It really is. The analysis also looked at the regression coefficient, which was 1.0152. That basically confirms that a $1 increase in these total debts corresponds to almost exactly a $1 increase in M2. It's a direct, almost perfectly linear one-to-one relationship. This is the structural proof baked into the financial accounts.
The charts show that near-perfect tracking, but the source material also mentioned a very recent, very sharp deviation starting around 2020. Both M2 and total debts suddenly spiked upwards even faster. What happened there?
Yeah, that deviation is clearly visible. That sudden acceleration was overwhelmingly driven by one component of total debts: federal government debts.
Ah, the response to the COVID-19 pandemic.
Exactly. The U.S. government unleashed massive fiscal stimulus, sending out checks, boosting unemployment benefits, loans to businesses financed by huge increases in borrowing. At the same time, the Federal Reserve ramped up its asset purchase programs, buying enormous amounts of that new government debt.
And because government debt held by the Fed and banks is part of total debts,
It immediately translated into a massive surge in M2. It's a very clear illustration of how quickly government borrowing, especially when facilitated by the central bank, can inflate the money stock, particularly when the private sector might be pulling back.
Okay, so the U.S. relationship is incredibly strong, almost perfect, with that recent government-driven surge. What about Japan? Did the M3 epoxy total debts relationship hold up there too, despite their, unique economic history with the bubble and stagnation?
Yes, the fundamental relationship holds strongly in Japan as well. For the JPY analysis covering 1980 through 2019, the correlation coefficient R between M3 and total debts was 0.9881.
Still very high, close to 0.99.
Very high, yes. And R squared was 0.976. So again, a very strong positive correlation confirming the basic principle: money is predominantly debt.
Although you mentioned earlier that the M3 fit wasn't quite as perfect as M1, and the source noted a period in Japan, roughly mid-90s to maybe 2015, where total debts actually seemed to underestimate M3 for a while. The lines diverged a bit.
That's right. There was an intermediate divergence. And the timing is highly significant because it corresponds exactly to the period after the Japanese economic bubble burst in the early 90s, leading into the long non-performing loans NPLs crisis that plagued their banking system.
So what caused that temporary gap where debt didn't fully explain M3?
The researchers couldn't pinpoint the exact cause with certainty from the available data. They proposed three main hypotheses. One was potential estimation errors in their own calculation models, though they felt that was less likely given the robustness checks.
Okay.
Another was the possibility of errors or inconsistencies in the original Bank of Japan, FFA statistics themselves during that chaotic NPL period. Given how messy the official BOJ money stock data was, as we discussed, it's plausible the underlying FFA data also had some issues then.
That seems possible.
And the third was related to how certain assets and liabilities might have been classified or valued during the NPL crisis, potentially distorting the measured relationship temporarily. But it requires further investigation.
But despite that intermediate wobble during a crisis period, the overall long-term picture for Japan is still clear. M3 largely tracks total debts.
Overwhelmingly, yes.
Yeah.
The fundamental structure is the same as in the U.S. Money is debt.
And this brings us to a really critical and often completely overlooked consequence of this system, the interest burden.
Yes, this is the immediate, unavoidable cost baked into the structure. If 99% of the money we use exists only because someone borrowed it at interest, then the entire economy is constantly on the hook for making interest payments just to keep the system going.
Can we put some numbers on that? What's the scale of this ongoing cost?
The source material offers an estimate. If you assume a very conservative average net interest rate of just 1% across all those trillions in money-creating debts.
Net interest rate, meaning after banks pay interest on deposits.
Roughly, yes. A very low estimate. Even at just 1%, the annual interest payments flowing from borrowers primarily into the banking sector amount to approximately $207 billion per year for the U.S. economy.
$200 billion every year.
Every year. And for Japan, the comparable figure is around 14 trillion yen annually. This isn't revenue banks earn for providing a service like safeguarding money. This is a mandatory continuous transfer payment inherent in the design of the monetary system itself. It's the fee for creating and using the medium of exchange.
And that leads to the most mind-bending and, frankly, alarming consequence. It really highlights the inherent instability. What happens if, hypothetically, everyone decided to be financially responsible in the conventional sense and pay off all their debts?
Economic catastrophe. Total system collapse. If all those interest-bearing money-creating debts were somehow paid off, the research indicates that 99% of the circulating money supply would simply vanish. Cease to exist. Poof. Using the regression results for Japan as an example, their M3 money supply is around 1,400 trillion yen. If the debts creating it were repaid, M3 would plummet instantly to just 17 trillion yen, the tiny fraction that isn't debt.
So the economy would just stop.
It would grind to an immediate halt. There'd be virtually no medium of exchange left for transactions. Commerce would cease. It's a system where the collective act of eliminating debt leads directly to economic oblivion.
That's a profound paradox. We live in a system that structurally requires perpetual and likely increasing debt just to function.
Precisely. It demands a constant stream of new borrowing, simply to maintain the existing money supply, let alone grow it. And think about the social implications we briefly touched on earlier.
Say interest payments.
Yeah. Where does that $207 billion in the U.S. or 14 trillion yen in Japan actually go each year? It flows overwhelmingly from the debtors, that's households, students, small businesses, corporations, governments, to the ultimate creditors.
Which are primarily
the shareholders and owners of the major domestic and international banks and financial institutions that create the money through lending. This built-in structural transfer of wealth from the broad economy to the financial sector is a massive systemic engine driving economic inequality and income distribution issues. It's not a side effect, it's baked into the cake.
Okay, so the data is overwhelming. M2 and M3 are basically mirror images of total debts. This forces us to completely ditch that old idea of banks as just passive intermediaries, simply lending out money that savers have already deposited.
We absolutely have to discard that myth. It's fundamentally wrong. As we saw, the amount of actual base money, physical cash, and central bank reserves, M0, is just a tiny sliver of the total money supply, M2 or M3.
Banks couldn't possibly lend out trillions if all they had was that small M0 base.
They simply don't have it to lend. So the question is, how do they create those trillions? What's the actual process? It's not lending in the way we normally think about it.
So if they're not lending money they already have, what are they doing?
They are essentially creating a promise of money, or more accurately, a bank liability that functions as money. It happens simultaneously with the creation of the loan asset.
Okay, walk us through that. A customer comes in for a loan, say a $300,000 mortgage.
Right. The bank approves the loan. Now, critically, The bank does not go into its vault, count out $300,000 in physical currency, and hand it over. That rarely, if ever, happens for large sums.
So what do they do instead?
They do two things simultaneously on their books. First, they record an asset. The customer's legally binding promise to repay the $300,000 plus interest. That's the loan, the bank's asset. Second, they credit the customer's deposit account with $300,000.
And that deposit?
Yeah.
That's the new money.
That deposit is the new money. It was created electronically, ex nihilo, out of nothing, at the exact moment the loan agreement was finalized. It exists purely as an entry on the bank's ledger, backed not by pre-existing funds, but by the customer's debt obligation.
It sounds like alchemy, or maybe accounting magic.
It does feel that way.
Yeah.
And this concept is so counterintuitive to our everyday experience of money that using a clear illustration really helps. The economist Irving provided a classic one back in 1935 to explain this process, often called fractional reserve banking.
Yeah, let's hear Fisher's example. How do you break it down?
Okay, imagine a simplified scenario. A new bank starts up in a community with $1 million in actual cash capital. Let's say that's its initial M0 base.
Okay, day one, they have $1 million cash.
On day one, they decide to lend out that entire $1 million. A borrower takes the loan, uses the money perhaps to pay wages or suppliers in the community, and very quickly, that $1 million flows right back into the same bank as new deposits made by those who receive the payments.
So after day one, what's the bank's balance sheet look like?
Assets. They still have the $1 million in cash, it came back, plus they now have $1 million in loan notes, the borrower's debt,
right,
liabilities. They owe $1 million to the new depositors. At this point, their cash reserve, or at Darrell, equals their deposits, $1. That's a 100% reserve ratio. Everything seems straightforward.
Right. It seems like they just moved money around. But the bank still has that original $1 million cash sitting there.
Exactly. Now, the bank knows it doesn't legally need to keep 100% reserves. Let's say the legal requirement is only 10%. They see that $1 million cash sitting idle and think, we can lend that out again.
So day two.
On day two, they lend out that same $1 million in cash again. Just like before, the borrower spends it, and it quickly flows back into the bank as another layer of deposits.
Ah, okay. So now what does the balance sheet show?
Now, total deposits have grown to $2 million. But the actual cash in the vault is still only that original $1 million.
So the reserve ratio has dropped.
It's dropped to 50%. $1 your cash, $2 M deposits. Already, Fisher points out, half of the money supply, $1 M of the $2 in deposits, is effectively a fiction. It's not backed by physical cash in the vault. It's backed only by the second borrower's promise to repay.
And the bank can just keep doing this, repeating the process.
They can keep repeating it, relending the same cash base, creating new loans and new deposits simultaneously until they hit the legal reserve limit.
Which was 10% in this example.
Right. So by day 10, if they repeat this process perfectly each day, total deposits will have ballooned to $10 million. The bank's liabilities are $10 million in deposits, but their assets still only include that original $1 million in cash. The other $9 million in assets are loan notes promises to pay.
So they've manufactured $9 million in new money out of thin air.
That's precisely Fisher's point. He called that $9 million the synthetic substitute for pocketbook money. It functions just like regular money, it circulates, but its origin is purely the bank's ledger entry created against the customer's debt. The customer thinks they borrowed existing money, but the bank actually used the customer's own future promise to pay as the raw material to manufacture the deposit they lent them.
It's an incredible sleight of hand. But if this is essentially creating money seemingly out of nothing and lending it at interest, how is it legal? How is it not considered fraud or counterfeiting?
That's where the legal structure underpinning the entire system becomes absolutely crucial. It hinges on a subtle but powerful legal distinction that goes back centuries, even to Roman law.
Okay, what's the distinction?
It's the difference between bailment and the deposit of fungibles.
Right, explain those. Bailment sounds like.
Bailment is simple safekeeping. Think of a coat check. You give them your coat, a specific non-interchangeable item, they hold it for you, you remain the owner, and they must return that exact same coat to you. They can't wear it or lend it out.
Okay, that makes sense. So what's a deposit of fungibles?
Fungible means interchangeable. Think of commodities like grain, oil, or cash. Under the legal principle of mutuum from Roman law, and reflected in modern laws like Article 666 of the Japanese Civil Code, when you deposit a fungible item like cash, something fundamentally different happens.
What's different?
Ownership transfers. When you deposit $100 cash into a bank, legally, you are giving ownership of that specific currency to the bank.
Wait, I don't own my money in the bank.
Not in the sense of bailment. The bank takes ownership of the cash. In return, the bank owes you a debt and obligation to return an equivalent amount, $100, of the same kind of fungible item, legal tender currency, on demand. You cease to be the owner of the physical cash and become merely a creditor of the bank.
So I don't have money in the bank. I have a claim against the bank for money.
Legally, yes, you hold a right to demand cash. This is a profound difference from what most people assume. And it's this transfer of ownership under the deposit of fungibles rule that gives the bank the legal right to use the cash you deposited, including using it as reserve to make new loans.
And that's why banks pay interest on deposits. It's not a storage fee, it's
essentially a borrowing fee. They're paying you, the creditor, for the right to use the funds you lent them by depositing. It's not a payment for safekeeping your property.
wow. Okay, that legal structure is the key.
It's the absolute cornerstone. It allows banks to treat all deposits the same way on their books, whether the deposit originated from someone handing over physical cash, what the research calls fiduciary origin, or whether it originated from the bank creating a loan origin. They're all just deposits liabilities owed by the bank, enabling the whole fractional reserve expansion process we discussed with Fisher's example.
It's so cleverly engineered, legally. It seems to sidestep what might otherwise look like, well, creating money without backing.
And that's exactly where some critics, particularly from the accounting profession, raise serious objections. They argue that this entire practice might actually violate fundamental accounting principles, like those found in IFRS or GAAP.
Really? What's the specific accounting critique?
The critique focuses on the definition of an asset. According to accounting standards, an asset is generally defined as an economic resource controlled by the entity as a result of past events, from which future economic benefits are expected to flow.
Okay, and the problem is the past events part.
Precisely. When a bank creates a loan, it acquires an asset the borrowers promised to pay, the receivable. But did the bank acquire this asset as a result of a past event, like spending its own resources or giving up something tangible?
No, you said it was created instantly, simultaneously with the deposit liability.
Exactly. The bank acquired the loan asset not by sacrificing an existing economic resource from its past, but simply by making ledger entries, creating the asset and liability simultaneously. Critics argue this instantaneous creation, without a cost basis rooted in a past event, means the resulting loan receivable might not technically qualify as a legitimate asset under strict IFRS GAAP definitions.
And if the loan asset isn't valid by that standard,
Then the corresponding deposit liability created at the same moment might also fail the test. It raises fundamental questions about the accounting treatment of the core banking function. Yet, despite these critiques, the current legal and monetary framework permits and relies on this very mechanism. It's the accepted alchemy of modern banking.
Okay, so we've established that 99% of money is created when a debt is created, like turning on a faucet. But this leads to the inescapable and potentially devastating flip side. What happens when the debt is repaid?
If money is born with debt, it logically follows that it must die when the debt is extinguished. This is the inherent fatal structural flaw of a system reliant on debt money.
The source material uses that analogy of two faucets controlling the money supply, right?
Yes, it's a useful way to visualize it. Faucet number 1 is controlled by the central bank issuing physical currency, adjusting reserve requirements, conducting open market operations. This faucet is generally slower, more deliberate, and controls only that small M0 base.
But the second faucet?
Faucet number 2 is controlled by the collective lending decisions of thousands of commercial banks. This is the faucet that creates the vast majority, the 99% of the money stock, M2, M3, through endogenous loan creation. It's much larger and reacts more dynamically to economic conditions and sentiment.
So if banks get nervous and stop lending, or if people and companies focus on paying down their existing debts faster than new loans are being created, that big second faucet goes into reverse.
Precisely. It becomes a drain instead of a source. When a borrower repays the principal on a loan, the bank does the reverse of the creation process. It reduces its asset, the loan receivable shrinks or disappears, and simultaneously, it reduces its liability by decreasing the borrower's deposit balance, or the deposit used to make the payment.
So the money that was created ex nihilo when the loan was made
Vanishes back into the same nothingness from which it came. It's a systematic, built-in process of monetary destruction. Repaying debt principal destroys money.
And we don't have to imagine this. We have a terrifying real-world example of this faucet going into reverse on a massive scale. the Great Depression.
Exactly. The source material uses the data from 1929 to 1933 as a stark case study of this monetary destruction mechanism in action.
Let's look at the numbers. During the boom years leading up to the crash, say 1926 to 1929, what was happening to the money supply?
It was expanding, driven by that second faucet. M1, a key measure of circulating money, increased by about $1 billion during that period. That was largely new debt money fueling the speculative boom.
Then came the crash in 29 and the faucet slammed shut, then reversed. What was the scale of the monetary destruction during the worst years of the Depression?
It was catastrophic. Between 1929 and 1933, M1 didn't just stop growing. It shrank by a staggering $7 billion.
$7 billion just disappeared from the economy. How?
It was driven by two main factors, both linked to the debt money structure, but the debt repayment effect was dominant. First, the wave of bank runs caused people to panic and hoard physical cash. They pulled money out of deposits. This drastically increased the public's currency holdings relative to deposits. The currency ratio jumped from 17.4% to 33.3%.
And hoarding cash restricts the bank's ability to lend or maintain deposits, right?
Yes, it shrinks the base for fractional reserve creation. But the truly massive destruction came directly from the repayment of debts. As businesses failed and people lost jobs, loans were either paid down as possible or defaulted on and written off through foreclosure. Each time a loan principal was extinguished, the corresponding deposit money vanished.
How much did the deposit part of M1 shrink?
Demand deposits, the checkable deposits that function as the primary medium of exchange, fell by an incredible $8 billion over that 4-year period.
$8 billion gone.
Gone. Irving Fisher, witnessing this firsthand, used a powerful analogy. He called the M1 money stock the economic highways necessary for trade and commerce. He said that $8 billion miles of these essential highways were suddenly destroyed between 1929 and 1933.
That's devastating.
It shows that the monetary contraction wasn't just a symptom of the Depression, it was a fundamental cause, or at least a massive accelerator. The destruction of the medium of exchange itself choked off spending, investment, and led to that downward spiral of economic collapse. The economy seized up because the money needed to run it was systematically destroyed through deleveraging.
This inherent instability, the system's tendency to wildly overcreate money during booms and then catastrophically destroy it during busts, it seems fundamentally flawed. Did people at the time recognize this?
Oh yes, very clearly. This terrifying experience was the direct impetus for some radical rethinking of the monetary system by leading economists of the era.
Like the Chicago Plan.
Exactly. The Chicago Plan for Banking Reform was developed in the heart of the Depression around 1933 by economists at the University of Chicago, including figures like Henry Simons and Frank Knight. And Irving Fisher became its most vocal champion, promoting it heavily in his 1935 book, 100% Money.
What was the core idea of the Chicago Plan, or 100% money?
They recognized that the root of the instability was the power of private commercial banks to create and destroy the vast majority of the money supply through their lending activities, that volatile second faucet. Their solution was elegantly simple, if radical.
Which was?
To completely divorce the function of money creation from the business of lending. They proposed imposing a 100% reserve requirement, specifically on-demand deposits.
Checking accounts.
100%. Meaning banks would have to hold $1 in reserves for every $1 in a checking account.
Precisely. This would effectively close that second faucet. Commercial banks would lose the ability to create new deposit money endogenously through lending via the fractional reserve mechanism.
So banks would become true intermediaries again. They could still accept time deposits, savings accounts, CDs, and use those funds or their own capital to make loans. But they couldn't create checking account money out of thin air anymore. The power to create the basic medium of exchange would rest solely with the government or central bank controlling the first faucet.
The goal was stability, then, to stop these wild swings.
Yes. To eliminate the chronic cycles of inflation, fueled by excessive debt money creation, and deflation, caused by debt money destruction, that they saw as inherent to the fractional reserve system. They wanted a stable monetary platform for the economy.
It sounds revolutionary, but also logical if the goal is stability. There's a powerful quote in the source material from Robert Hemphill, who is involved with the Federal Reserve, summarizing the precariousness of the existing system.
Yes, Hemphill wrote the foreword to Fisher's 100% Money, and his words are chillingly direct. He stated, and this is almost a direct quote, "If all the bank loans were paid, no one could have a bank deposit, and there would not be a dollar of currency or coin in circulation." This is a staggering thought.
Staggering is right. He basically said our entire money supply depends on someone, somewhere, being in debt to a bank.
He laid it bare. He continued, "We are absolutely without a permanent monetary system. When one gets a complete grasp of the picture, the tragic absurdity of our hopeless situation is almost incredible." His point was that prosperity itself hinges precariously on the bank's willingness and ability to create sufficient synthetic money through debt. If they lend freely, we boom. If they contract, we starve.
So think about that as a listener. Your ability to get paid to buy groceries fundamentally depends on the continuous creation of new debt within the banking system just to keep the wheels turning. That's the system Hemphill and Fisher saw as absurdly unstable.
Now, this understanding of the debt money system, its creation mechanism, its destruction mechanism, its inherent instability, provides a really powerful lens for analyzing Japan's economic experience over the last few decades.
Well, the famous lost 30 years, decades of economic stagnation despite, on the surface, doing what the textbooks recommend.
Exactly. Japan, since the early 1990s, has implemented massive, sustained, counter-cyclical fiscal policy. Huge government spending, running large deficits, exactly the kind of Keynesian intervention you'd expect to fight stagnation. Yet the economy remained largely flat.
So why didn't the stimulus work as expected?
The debt decomposition analysis in the source material, breaking down total debts into its private and government components, reveals three quite surprising facts or paradoxes that help explain this puzzle.
Okay, let's take them one by one. What's the first surprise?
The first surprise directly contrasts with the Great Depression experience we just discussed. Unlike the U.S. in the 1930s, Japan's total money supply, M1 and M3, did not contract after its massive asset bubble burst in 1990. In fact, it steadily increased throughout the lost decades.
Wait, so money supply went up, but the economy stagnated. That seems backward. If monetary contraction caused the Great Depression, shouldn't monetary expansion have prevented stagnation in Japan?
That's the paradox. And the answer lies not in the total quantity of money or debt, but in the quality or composition of the debt that was creating that money.
Meaning we have to look at who was doing the borrowing, private sector versus government.
Precisely. The data, specifically figure 3.8 in the source, shows a dramatic shift. After the bubble burst, private sector debts loans taken out by households and productive businesses began to decline sharply from the mid-90s onwards.
Which, based on what we learned, should have destroyed money and potentially caused a deep depression, right?
It should have, just like in the 1930s U.S. But it didn't. Why? Because at the exact same time private debt started falling, government debt began to soar. The Japanese government stepped in with massive deficit spending, effectively replacing the collapsing private borrowing with public borrowing.
So the rise in government debt offset the fall in private debt.
Almost perfectly, for many years. The result was that total debts, the sum of the two, remained relatively stable or even continued to rise slowly. And because total debts approx M3 dollars, the overall money supply, M3, also remained stable or rose.
So the total money supply figures mask this huge underlying structural shift.
Exactly. The government's intervention successfully prevented the catastrophic monetary contraction seen in the 1930s by keeping the total debt level up. Faucet 2, private lending, was closing, but Faucet 1, government borrowing via bank SPOJ, opened wide to compensate. But the nature of the economic activity being financed had changed dramatically, from potentially productive private investment fueled by private loans to government spending often aimed at just maintaining activity or supporting zombie companies financed by public deficits. M3 stability was achieved, but the engine for genuine, compounding economic growth, which relies heavily on private sector leveraging and investment, had stalled.
That's fascinating. Okay, what was surprise number 2? You mentioned it challenges basic macro theory.
Yes, this one challenges the standard textbook sequence of savings, investment, and loans. The mainstream view, going back to classical economics, generally assumes a flow that starts with savings.
Right. People save money, deposit it in banks,
Banks then act as intermediaries, lending those savings out.
which funds investment by businesses or individuals. So savings, dollars, loans, dollar investment. That's the conventional story.
But the debt money reality, supported by the data, seems to operate in reverse. The research found a very strong statistical correlation in Japan specifically between time deposits, which are a major component of national savings, and private debts, those loans to households and firms. The R value was 0.9539.
Okay, high correlation. But why does that suggest the standard theory is backward?
Because in a debt money system, the loan has to come first to create the money that can eventually be saved. Think about the flow. A business borrows from a bank. private debt increases, creating a new deposit.
Okay, money is created.
The business then spends that borrowed money, perhaps on investment, building a factory, or paying wages, consumption.
That spending becomes someone else's income.
Exactly. That spending generates income for workers, suppliers, etc. And it's only after receiving that income that people can choose to save some portion of it, perhaps by putting it into a time deposit.
So the actual flow is borrowing, investment, consumption, income on income, saving, time deposits.
That's what the debt money perspective in this correlation suggests. And it perfectly explains another aspect of Japan's stagnation. Why did savings rates, especially time deposits, plummet after the bubble burst? Not because people suddenly decided not to save, but because private sector borrowing and investment collapsed first. With less borrowing and investment, there was less income generation, and therefore less money available to be saved. Savings fell because borrowing fell, not the other way around. The engine stalled at the borrowing investment stage.
Wow, that really flips the script on cause and effect in macroeconomics. Okay, what's the third surprise from the Japan analysis?
Surprise number 3 pins down exactly what was driving the money supply that did remain specifically the most liquid part, M1. We saw total debts explained M3 overall, but when you look closer,
You find government debt playing the key role.
overwhelmingly so for M1. The analysis found the single strongest correlation was between M1 and government debts. The R value here was an incredibly high 0.9934.
Almost perfect again.
A near-perfect linear relationship.
Hmm.
The regression analysis quantified the impact. The researchers concluded that the cumulative increase in Japanese government debt between 1990 and 2019, which amounted to about 595 trillion yen,
Yeah.
was directly responsible for generating most of the 731 trillion yen increase in M1 observed during that exact same period.
So there's a direct causal link. The government running deficits and issuing debt, which was absorbed by the banking system and the BOJ, was literally creating the M1 money supply needed to keep the economy liquid.
That's the conclusion. The aggressive, sustained fiscal spending, financed by debt, was the primary lifeline preventing M1 from collapsing. It was absolutely necessary to avoid a 1930s-style deflationary spiral.
But it wasn't sufficient to restart growth.
Exactly. It kept the monetary lights on, preventing a collapse, but it failed to reignite the engine of private sector borrowing and investment. It sustained liquidity but didn't generate prosperity, leading directly to that paradox of the lost 30 years, a stable or rising money supply alongside economic stagnation.
And we saw the U.S. basically use the same playbook after the 2008 crisis, didn't we? Private debt collapsed, and the government stepped in with massive deficits.
Yes, the source material notes that the U.S. data post-2008 shows the exact same functional breakdown patterns emerging. As private debt faltered, M1 increasingly began to track government debt, while time deposits, savings, remained more aligned with the trajectory of the remaining private debt. Both countries, facing a crisis triggered by the collapse of private debt creation, resorted to the same structural fix: use public debt creation to plug the hole and prevent systemic monetary contraction.
But here's the crucial difference, right? The U.S., while maybe not spectacularly, did eventually return to a semblance of economic growth after 2008. Japan largely hasn't, despite decades of stimulus.
And that's the million-dollar or perhaps trillion-dollar question that emerges from this comparison. If the fundamental monetary response mechanism substituting public debt for private debt to stabilize the money supply was structurally similar in both countries.
Why were the ultimate economic outcomes so different?
Exactly. It implies that while the debt money system's mechanics create a common structural challenge during deleveraging crises, other factors must be modulating the results. The source material touches on one major potential difference: demographics.
Population trends.
Yeah. The U.S., despite its challenges, maintained positive population growth and a relatively younger demographic structure. Japan, famously, has been facing population decline since 2011 and has one of the oldest populations in the world. This demographic drag might be a key factor limiting the effectiveness of fiscal stimulus in reigniting private sector demand, investment, and ultimately growth, even when the monetary base is being supported by government action. #outro.
This has been, well, quite a journey into the very foundations of our financial system. It's a lot to take in, but let's try and synthesize that core finding one last time.
The fundamental takeaway is this: the overwhelming majority, around 99% of the money supply in major economies like the U.S. and Japan, isn't created by governments printing cash. It's created endogenously by commercial banks, simultaneously with the creation of interest-bearing debt.
Money is debt. Debt is money. They're essentially two sides of the same coin for 99% of the system.
And this structural reality has profound consequences. It inherently links our economies to cycles of boom and bust, driven by the expansion and contraction of bank lending, the often irresponsible creation and subsequent destruction of money. It means our system requires a constant and likely growing stream of new borrowing just to maintain basic functionality, let alone achieve growth.
Understanding this really changes how you have to view everything in finance, doesn't it? When you look at your bank balance, you're not seeing your property held in safekeeping.
You're seeing the bank liability to you, your creditor. You've lent them money, legally speaking.
And when you hear about the government running a budget deficit and issuing bonds,
You need to understand that to the extent the banking system absorbs that debt, the government isn't just spending borrowed money. It's participating in the functional creation of the new M1 or M2 needed to keep the whole system from seizing up, especially when private borrowing falters.
it reframes the entire debate.
It really does. So let's leave you, the listener, with that provocative thought we touched upon right at the end, comparing the U.S. and Japan post-crisis.
If both countries use the same fundamental monetary playbook, massive government debt creation to offset private debt destruction and stabilize the money supply, why did the U.S. manage to eventually find new paths to growth after 2008, while Japan, despite decades of effort, remained largely stagnant?
Is the difference purely down to non-monetary structural factors like Japan's demographic decline, which might place an ultimate limit on private sector demand regardless of stimulus? Or are there other subtle regulatory, cultural, or policy factors that prevented the engine of private debt creation, the mechanism that truly drives deposit growth and potentially fuels expansion, from reigniting effectively in Japan?
Understanding that difference, why one recovered and the other stagnated despite similar monetary interventions, might hold the key to unlocking the deeper secrets of growth versus stagnation in our modern debt-based financial world. Something to ponder.
Absolutely. Keep questioning, keep digging.